What if I told you that the secret to building wealth in the stock market isn't about picking the next big stock, timing the market, or following the latest trading trend? Imagine a strategy so simple, so powerful, that even Warren Buffett calls it the best way for most people to invest. Welcome to TradeInvestor, where we cut through the noise and bring you timeless practical lessons for financial independence. Today, we dive deep into John C. Bogle's legendary book, The Little Book of Common Sense Investing, to reveal why the simplest approach is often the most effective, especially for Indian retail investors. Introduction: The Bogle Philosophy. John C. Bogle, the founder of Vanguard Group, revolutionized investing by creating the world's first index fund. His core message is clear. The simplest and most efficient investment strategy is to buy and hold all of the nation's publicly held businesses at very low cost. In other words, own the entire market through a low-cost index fund. Hold it for the long term and let compounding do the rest. Today, we'll break down Bogle's key lessons, bust common myths, and show you how to apply these principles in the Indian context. Section 1. Why most investors lose: the cost of chasing returns. Let's start with a hard truth. Most investors, including professionals, underperform the market over the long run. Why? Because they try to outsmart the market, buying, selling, timing, and paying high fee to fund managers. Bogle calls this the loser's game. The more you trade, the more you pay in costs, and the less you keep in returns. Key Indian insight: every time you buy or sell, you pay brokerage, SGT, taxes, and hidden costs. Over time, these eat away at your profits. Section 2. The power of index funds. Owning the market. So what's the alternative? Bogle's answer: passive investing through index funds. An index fund simply buys and holds all the stocks in a market index, like the Nifty 50 or Sensex in India. No stock picking, no market timing, just broad diversification and minimal costs. A portfolio focused on index funds is the only investment that guarantees your fair share of stock market returns. Benefits for Indian investors: you own a slice of every major company in India. You reduce the risk of picking losers. You save on costs, which boosts your long-term returns. Section 3. Why costs matter: the silent wealth killer. Bogle's most powerful lesson: costs matter a lot. Actively managed funds charge high fees, sometimes 1.5% to 2.5% per year in India, while index funds and ETFs can have expense ratios as low as 0.1 to 0.3%. The more the managers and brokers take, the less investors make. Let's see the impact. If you invest 10 lakh rupees for 30 years at 12% annual return, a 2% fee reduces your final wealth by over 40% compared to a 0.2% fee. Actionable tip: always check the expense ratio before investing. Prefer low-cost index funds and ETFs for long-term wealth building. Section 4. The myth of market timing and stock picking. Many believe they can beat the market by picking the right stocks or timing their entry and exit. Bogle debunks this myth with decades of data. Most active fund managers fail to outperform the index after fees. Even experts struggle to consistently pick winners. Attempting to time the market or selecting winning stocks is often counterproductive and leads to lower returns. For Indian investors, don't waste time chasing hot tips or trying to predict market moves. Stick to a disciplined and passive approach. Section 5. The magic of compounding. Let time do the work. Bogle emphasizes the power of compounding, earning returns on your returns year after year. The longer you stay invested, the greater your wealth grows. Frequent trading disrupts compounding and increases costs. Indian context. Start a SIP, that is systematic investment plan, in an index fund. Stay invested through market ups and downs. Let compounding work its magic over decades. Section 6. Business reality versus market expectations. Bogle distinguishes between business reality, the actual growth in earnings and dividends, and market expectations, the daily noise of stock prices. In the short term, stock prices go up only when the expectations of investors rise, not necessarily when sales, margins, or profits rise. Over the long term, it's the business fundamentals, that is profits, dividends, and growth, that drive returns, not speculation. Key takeaway: focus on owning the market, not predicting short-term price movements. Section 7. The impact of taxes and inflation. Bogle warns that taxes and inflation can silently erode your returns. Short-term trading leads to higher taxes in India due to short-term capital gains. High inflation reduces your real purchasing power. Now, how index funds help in this? Lower turnover means fewer taxable events. Long-term holding qualifies for lower long-term capital gains tax. One practical tip: hold your investment for more than 1 year to benefit from favorable tax treatment. Section 8. The wisdom of great investors. Bogle's ideas are backed by legends like Warren Buffett, Benjamin Graham, and Paul Samuelson. Buffett himself said, "If a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle." These giants agree. For most investors, low-cost index funds are the smartest, safest path to wealth. Section 9. Asset allocation and retirement planning. In the updated edition, Bogle adds guidance on asset allocation and retirement investing. Decide how much to invest in stocks versus bonds based on your age, goals, and risk tolerance. As you near retirement, gradually increase your asset allocation to safer assets. For Indian investors, use a mix of equity index funds and debt funds or government bonds. Review your allocation every few years, not every few months. Section 10. How to start index investing in India. Let's make it practical. Choose a broad market index fund or ETF. Nifty 50, Sensex, or Nifty Next 50 index funds are good starting points. Check the expense ratio. Lower the better. Set up a SIP. Invest a fixed amount every month regardless of market conditions. Avoid frequent trading. Buy and hold for the long term. Rebalance occasionally. Adjust your allocation if your goals or risk profile change. Section 11. Common questions and myths busted. Isn't active investing better in India? Data shows most active funds underperform their benchmarks after fees, even in India. What if the market crashes? Stay invested. History shows markets recover and grow over time. Can I get rich quickly with index funds? No. Index investing is about steady, long-term wealth, not overnight riches. Section 12. Key takeaways for retail Indian investors. Let's recap the timeless lessons from the Little Book of Common Sense Investing. Keep it simple. Own the whole market through low-cost index funds. Minimize costs. Every rupee saved in fee is a rupee earned. Don't try to outsmart the market. Focus on time in the market, not timing the market. Let compounding work. Start early, stay invested, and watch your wealth grow. Stay disciplined, ignore the noise, stick to your plan, and rebalance only when needed. If you are tired of confusing advice, endless stock tips, and high costs eating into your returns. It's time to embrace the common sense approach. At TradeInvestor, we believe financial independence is within your reach for every Indian retail investor, not by chasing fads, but by following proven principles. If you found this audiobook summary of the Little Book of Common Sense Investing valuable, hit like, subscribe, and share your thoughts in the comments. Are you ready to start the index investing journey? What's holding you back? Stay tuned for more audiobook summaries, deep dives, and practical investing strategies right here on TradeInvestor, where we talk basics to brilliance. A point to remember: sometimes the simplest strategy is the most powerful. Invest with common sense and let the market work for you. Thank you and Jai Hind.